Good afternoon. I'm glad to have everyone here. Looks like we have people joining quickly. It's 1 o'clock here on the East Coast, so we'll get started. And first of all, I'd like to apologize to those of you who were registered 2 weeks ago. Technical difficulties, but from our webinar hosting company, and we weren't completely sure they would be back and up and running by the time of our webinar, so sorry about that. It did allow us to open the seminar up to other people because there was big demand for this, and not surprising because this is a hot, complicated topic. Might be a little challenging to fully discuss in an hour, but I think that if we can lay out the major concepts and you have a good working knowledge of how the process works, then that at least allows you to know what your questions are. And of course, we're always happy to be a resource for people if a week from now you pull out your notes and wonder what that was about. We're happy to answer more questions. So thank you for joining us. We have a full house. There are people from major national corporations. There are directors. There are company owners. There are broker friends, and we're always glad to have them, and people all over the country and in Canada. So you guys will be a wealth of resource for each other. So as we go through the seminar, note that to the right of your screen is a panel box, and there are two things there. One thing is a resource for our handout, which is the PowerPoint presentation you see on the screen. If you were registered in advance, you should have received that yesterday by email, but if you want to pull it up now or later, you can pull that up and print it out. Also, there is a box for questions, so if you have a question or a comment, please ask it or make the comment. Again, you guys have great information out there, and please share or ask any questions that you might have as we go. This is my absolute favorite topic. How we value in the industry, and sometimes I forget to say some things that because I talk this all day long, and so if I skip over something or don't make something clear, please ask it. After the webinar, you will have access to it online if you go to our website. Also, you'll get an email with a survey about what you thought about this webinar. Please take just a minute and do that. We're trying to host these every other month, and we would really like to make them topics that are relevant and useful to you. And feel free to give us constructive criticism because we're always happy to make adjustments and make this worth your lunch hour. So thank you for that. This is the first in a two-part series on valuation, and again, so we're allocating 2 hours to it, this hour to business valuation, and the second hour, which will be held on November 19th, on real estate valuation, and that's pretty aggressive to do those two things in an hour, but again, we can follow up with some additional information. The second part on real estate valuation on November 19th will be held by Mike Pepper and Reagan Curley, our two lead real estate brokers on our team. Reagan's located here in South Carolina with me. Mike's in Denver, Colorado, and we cover the country that way. I think I have Mike on the line, and I'd like to ask him to give you just a brief overview before we start on business valuation on what the real estate valuation will be, just an overview of what we'll talk about on that because there's so much going on in the world of real estate in our industry right now. So can we get Mike, can you jump in here and give us a couple of minutes on what that will cover?
You bet. Can you hear me?
We got you.
All right, great. Thank you, Kathy. Yes, we're excited to discuss real estate valuation as it pertains to our industry. The general trends in the real estate world are strong. Prices are higher than they've been for as long as we can remember, and with the volatility in the stock market, we're expecting that there will be continued persistent interest in real estate investments. We'll be discussing how owners of the center buildings can maximize their valuation when it comes time to sell. We'll talk about acquisition strategies as well, because we help people both acquire and sell. We'll talk about how real estate is valued, and we'll be discussing such terms as a cap rate, a REIT, a sale leaseback, and other jargon that's used in the industry, so that you'll have a leg up when it comes to engaging in those discussions. So we'll cover a wide variety of issues. We'll cover macro level issues as well as micro level issues as it pertains to certain geographies around the country, and the economics of valuing real estate at an individual school basis.
Terrific. Okay, thanks for that overview, Mike. I think you guys will be very interested. I will allude as I go through the business valuation to some of the things going on in the real estate part of our industry. There's been more change in that area in the last year than there has been in business valuation, but both are very positive and moving forward quickly. So as I talk through the concepts of business valuation today, I may use buyer or seller that you decide to be a seller. Anytime you get the opportunity to look at a business, I suggest, even if you are very sure it's not for you, that you step up and take a look at that, just because the experience that you go through is valuable. You'll learn something, you'll take something away from it, something might help you want to do an event on your own, because our objective, if you are an owner, you are going to exit this business at some point. And what we want you to do is do that at your very best point and in a way that maximizes value for you. So you may hear me use these terms interchangeably today. So here's what we're going to talk about today. All right. So our objectives today are, first of all, I'd like to talk about what's going on in the marketplace overall and why that matters to you. The second thing is that I want to give you a big picture of the methodology to value a school and just talk through it, and then we're going to go through each step individually. We'll talk about step one, what is the value based on? Step two is to maximize the number that it's based on, which is EBITDA or cash flow, which we'll define and talk more about. We'll talk about the multiple that number is multiplied by to get the value and what that consists of. And then we'll do an example so that you can see how those numbers work. So that's where we're headed. So let's start with the first part. Well, sorry. So let's talk about what's going on in the world. And the reason that this matters to you when you're in your daily world and you're, everybody's out sick and you're trying to get the toilet fixed, and why does what everybody else is in the world, why is what they're doing matter to you and your company? Well, the national transactions and the national trends that are going on really set the benchmark for even a single site transaction, regardless of who it gets sold to. So for you to know and have access to what's going on there will help you make business decisions on your own. So some of the things that have happened in the last 12 months, there have been soon to be the third very major transaction in our industry that sort of sets the benchmark for what's happening for business sales. The first one was that Nobel Learning, based in Pennsylvania, a very upscale company, one of the largest in the country, operating about 200 sites, sold from one equity group to another. So when I say equity group, most of the major national companies are owned by private equity companies. Private equity just meaning that this group takes private individuals' money and invests it. So their game is to buy a company, get it more profitable, add on to it with acquisitions, and then sell it in about 5 years for a higher number. So that transaction traded at a very large multiple, larger than we've seen in our industry. And that set the game rolling for an uptick of the numbers we see for other businesses. The second one was about 2 months ago, and that company was Knowledge Universe that operates KinderCare and Children's World, also traded at a very strong number. And there's a third national company that will transition in the next couple of weeks, also at large numbers. So when those things happen, the rest of the investment world and those companies and other large ones that want to grow their company start to take a look at those trends, and it moves numbers upward. So we're seeing a real upward tick in multiples, which we'll explain in a few minutes again. So those things happen and make a big difference to everyone in the industry. We're seeing an increase in institutional investment, and again, that mainly means private equity. So as opposed to an individual who owns a company, more investment by private equity groups into our industry. At the same time, we're seeing more investment by those same institutions into real estate, or from institutions that Mike and Reagan will talk more about on the next seminar. Also, we're seeing more creativity around what's going on. So the process is much more than just what price do you want, what price will I pay, how can we come together. There are very creative ways to get to things that add value. Do you do a development contract for the seller? Do you want to employ that person for a salary afterwards? Do you pay in all cash or a note, and what is the interest rate? And a lot of creativity, believe it or not, around real estate transactions right now too. So the industry is getting more flexible in the way that they put together deals, and so that they meet everyone's objective and also get them more value. So more movement than my soon-to-be 30 years in the industry have ever seen. So good news if you're a seller, probably not so good news if you're a buyer, because those numbers are going up and it's getting more competitive. So let's talk about the methodology, and what I like to do first is just lay this out so that the concepts, the terminology basically makes sense and sounds familiar, and then we're going to walk through each one of these steps. So if you'll just give me that, I'm going to lay out the big picture. This is on one slide, the complete methodology that happens when we or anyone else, and everyone in the industry does this the same way. So this is not unique to our company or our buyers. It's the way the world values companies. Are there some outliers, and sometimes people do things differently? Yes, but they're rare, and they're the exception to the rule for sure. So basically what we're trying to get to is, if you think about this logically, if you are going to buy a business, what do you want to base that value on? And logically, what you want is to gain cash flow. So you want to make money when you buy this business. So what you're trying to figure out is, how much money are you going to make off of this business? How much cash are you going to make off of this business after you buy it? So some things are important. Their historical numbers are important. What they've done in the past, what you can change about it, those are important. But what you really want to know is, how much money are you going to make off of it? And then the second thing you want to know is, how long do you want it to take before that investment starts paying you? So do you want to pay 3 years worth of cash flow so that you're not actually making money until the 4th year because you just paid the seller for the first 3 years? How long do you want it to be before you gain your investment back? So logically, that's where we're going with this calculation. So here's how it happens. The first thing that we do, and again, I'm going to talk through this, then we're going to go to individual slides that break down each step. So the first thing we want to do is, we want to start with the most recent rolling 12 financial statements. So we have to have very current numbers. Then we want to adjust to go forward EBITDA. All that means, and I say it that way because you're going to hear that again if you ever look at a transaction. And when you hear the term EBITDA, think cash flow in your head. So what it means, EBITDA, earnings before interest, taxes, depreciation, and amortization. All that means is I'm going to take out all those things that are non-cash so that I get to a number that says this is how much cash I'm going to make going forward. So all we're doing is removing things that don't affect cash so that we know what the bottom line of cash is. So this EBITDA thing is not a complicated concept. It's just one of those terms that accountants like to throw out to make us, I'm one so I can talk about us, make us sound smart when it's really just a very simple concept. But if you hear it again, think cash flow, because EBITDA is the language of what we base the value on. So we adjust to go forward EBITDA or cash flow. The second part of that is we adjust to anything that's going to change from the seller to the buyer. Once we get the number and we're happy that we know what that annual cash flow number is, we apply the multiple, so we're multiplying. And again, that means how many years do I want it to take before I'm going to recoup my investment. And then we use all of that information to calculate the real estate value. So I'll just say this very briefly. This isn't intended to talk about real estate. That'll happen next time. But a lot of people don't understand that if you have an operating business in a piece of real estate, that's the main driver in what your real estate is worth. So the real estate is worth what that business can afford and produce to pay for that real estate. Without the business in it, you know, you're doing a typical appraisal. So we have lots of conversations with people about what things are going for in their area and the recent appraisal that the bank did. But basically, if there's an operating business in the real estate, that's what drives the value. So now I'm raining on Mike and Reagan's parade, so we'll go past that. Okay, so there's the big picture. Now let's break this thing down into steps. So step one, start with the most recent 12 rolling financial statements. So let's talk about that a little bit. So most people in the industry, and if you are an owner, and this is true of you, don't feel bad about this, but most people in the industry with smaller companies produce their tax return annually, and that's pretty much it. And they're actually really good at managing by how much money is in the bank. And so the information is limited, and that's all that they have. And we used to, in the former world of selling companies, be able to get by with that throughout the year. But in today's world, it changes, things change so quickly that your financial picture today and a month from now could be drastically different. So if you're a buyer and you're looking at a company, don't consider making an offer and getting closed on something if the information is older than about 3 months old. So that's kind of our benchmark. And so when we say rolling 12-month financial statement, what we mean by that is it can start any month and end any month. So if you're a calendar year company and you produce a tax return, that's fine. But if I'm looking at your company right now in October and wanting to value it, I would say to you, what is the most recent 12 months of financial data you could produce? So if you're up to date and you produce financials monthly, and you probably don't have September yet, unless you're better than anybody else I know on October 1st, you probably have produced financials through August of 2015. So what I would be asking you is, can you produce for me September 1st of last year, September 1st of 2014 through August 31st of this year, 2015. So it's a 12-month period. That's why it says rolling 12 months, because it rolls around the calendar, and it's a consecutive 12 months, but not necessarily a calendar year. But you want it as up to date as possible. Some people get confused about that concept. I get people asking me questions like, well, I'm weak in the summer and I'm strongest in the spring. Well, it's still 12 months. So, you know, it doesn't match up with the calendar year or the school year, but it's still 12 months. So all those things are still in effect. If you're a company who's on an upswing and your numbers are constantly getting stronger, then that's good for you because that value is going up quickly. So start with the most recent 12-month rolling financial statement. So the example that we see in just a minute, we are assuming is a very up-to-date financial statement. Okay, step 2, adjust to go forward EBITDA. So again, like we said a minute ago, the objective is that we are looking at a company, they have an owner in there and the owner is drawing a salary, their car is being paid for by the company and their benefits, and all those things are okay. So I get this question a lot as well. It's perfectly legal and fine for you to use personal expenses in your business if they're a part of your business. So you're using your car, you're using your cell phone, you're a part of the company, and to take a salary and benefits, those are perfectly fine. But if you are operating the company and you aren't there after closing, all of those expenses go away. So the first thing to do is to take the current financial statements, remove the things that are non-cash, like we said, interest, taxes, depreciation, and amortization, then make any other adjustments that are going to change from closing day on Friday to opening day on Monday. So if the owner is being removed, and in this example, I'm assuming there's a manager in place and that's stable, and the owner being removed does not have to be replaced. If they do, you have to figure that out. So you have to remove the owner, but then you have to add in the expenses of somebody else. So what you're doing here is really thinking through everything that might change financially from the day it closes from one owner to the and knowing your target here is vital. So you need to really take very special care to know what, if you're the buyer, you really need to know what's going to go away, but you need to know what expenses you're going to have to put in there that they might not have. For us, if we're selling to a national group, we can be a little more aggressive because we know that some of the expenses that an individual owner has, this national group won't have. So a lot of this is some industry knowledge that I suggest getting an industry expert involved in doing this analysis with you so that you can maximize value, regardless of who you are, the buyer or the seller. So some of those things, and this is not inclusive because, again, every situation is different, but some of those things that might change, we mentioned already, any owner personal expenses, rent may change. If you own your building and you're selling your company and you're paying yourself a certain rent, you might want a different amount of rent. If you're considering keeping your real estate, that might change. If you're selling your real estate, then that's nothing to worry about. Benefits, to include health care, are often different from one company to another. Property taxes, if there's one company that doesn't pay it in the operating company but another one is. Insurance is often different. So I'm really skirting over some of these quickly. There are a lot of them, and I have to sum that up by saying that every person's financial situation, both on the buy and the sell side, is different, and the valuation is different. So depending on who the potential buyer is, the valuation is different. So you can't do one valuation and then say, you can present it to everybody the same way, but everybody's financial picture later on doesn't look the same, which is why some people can pay more money than other people. Okay, so hopefully that wasn't too much Greek. All right, so we've agreed that we have now gotten to the point where we have a EBITDA or a cash flow number on a go-forward basis to base this value on. So let's look at an example financial statement. Maybe this will help a little bit. Okay, so this is page 1 of 3 in this financial statement. And if you've attended any of our financial webinars in the past, you have seen this pro forma. I'd like to take just a minute to explain where it came from. This is available for you to use as a benchmarking tool. Just send us an email and ask us for it. It's in Excel and we'll send it to you. It's made so that you can input your company's license capacity, tuition rate, and revenue on an annual basis, and then the expense fields populate. And what that will tell you is an average financially healthy company in this industry would spend about this much in that category. And every school's a little bit different, so it's a benchmark. It's not gospel. So you need to know that, maybe parents bring food at your school, but the average company provides food, so that might be a difference. So you'll know that there's some things that are different. When we value, we put everyone's numbers in our format, which is this format, because it allows us to immediately see anything we need to ask questions about. So we scrub these numbers really strongly before we advise anybody. I don't say we don't ever find surprises, but we certainly want to minimize surprise the transition. So this is the format where this 25 years ago, there were a group of national providers, and we all got together and we shared numbers, and I built this pro forma originally, and it was very similar. And what we find out over time, because we're privy to a lot of people's numbers, we don't give those out, they're confidential, but we do temper this analysis with those numbers, and over time very little has changed. The two things that I've seen change are marketing costs, which get less expensive all the time because we moved from yellow pages to social media marketing. The second thing that's changed is employee benefits in the other direction, because we're all trying hard to comply with healthcare laws and provide good benefits for staff, but very little. So if you look at it in total, very little has changed. So what I've done is highlight here a couple of expenses that may change. So we think of this as the original numbers we get from someone whose company we're considering. We want to value this company, and here's what they did for the most recent 12 months. So this is their actual performance for September 1st of 2014 through August 31st of 2015. So this is the basis of the valuation that we're going to base our offer on. So the things I've highlighted could change. So if you go up to the top, actually salaries could change if there's a management change. Employee benefits could change. You could be spending more and you need to add to it, or you think you can be more cost effective than that person is, so you need to take away from it, you need to make that adjustment. If you look down through here, this company had a vehicle lease, and maybe it's negotiated that they're going to pay that vehicle off, or maybe you're going to continue it. So you need to know those kinds of things. Do I leave it in? Do I take it out? Maybe I'm going to replace a vehicle and I'm going to need to add in more money, so that would be an adjustment to make. Typically, most people want to believe that they change very little, at least for a while, after an acquisition. So the last thing you want to do is feel like you have to make drastic changes that affect anything financially. If you do that, it makes people really nervous, and you could jeopardize the business that you're acquiring. So you want to believe that you can live with most of these expenses at least for a short amount of time. So you wouldn't want to make broad changes. So page 2 of this, we get down to the building cost. Again, we mentioned that there could be a change in what the former owner is paying in rent, what the new owner will. Look at things like insurance. Is your insurance less expensive? Is it more expensive? Are property taxes included, and are you going to have to pay those now, and what are they? Things like in the administrative costs, things like credit card fees. I see people change frequently. So you may have a parent base that uses a lot of credit cards. You may have some that use none. You don't offer it, but now you want to. And those fees can be significant. So to know those things is important. So you really have to think through your entire business. What might change? I've got their numbers. What might change? what is going to change based on the way we're structuring this offer, and then what's the go-forward financial picture going to look like. So if you can see down there on the very last line that where it says annual cash flow, what we have assumed is that once we made our changes, this company will produce $177,181 a year in cash flow. So successful, very financially healthy company for us to base an offer on. And when we're talking about, I'm sorry, I should have said this at the very beginning. When we're talking about the business value, what's getting paid for the business also includes the business assets. So not the real estate, not the building that it sits in, that's separate, and that's coming next month with Reagan and Mike, but the business assets that generate that revenue. So the vehicles, the furniture in the classrooms, the equipment, the curriculum, the goodwill, which are the parents and the names and the ability to continue that business, those are all considered business assets. And when we base this offer on cash flow, it includes all the business assets. There's, and I hate doing this, but there's situations where there's no cash flow to base a business transition on. And why would you do that? Well, there would, you know, if someone's in trouble but they want to transition to someone to get out of the business, and there's no cash flow to base it on, what do you do? First of all, don't get yourself in that situation. Talk to us way ahead. But we can usually justify at least value for equipment, furniture, and fixtures. An average school with, you know, an average age on those things, we would, you know, 50 to 100,000 would kind of be a minimum. I don't ever want to see somebody just hand their keys over to somebody and say, come on in here. There's always some value. So even though those things are included in cash flow value, if there's no cash flow, we can usually at least assign enough value if someone wants the business. So page 3 to this. So when you see reconciliation to financial statements, this is our form, but these are all the things we've removed for this particular seller. We've taken out, if you see down, related to the former owner, their salary, their auto, their benefits, their telephone. I'm taking anything out that I can get away with. So if I'm representing you and you're a seller, then I'm going to be as aggressive as possible about removing expenses from your financial statement. If you're a buyer and I'm representing you on that side, then I'm going to be as aggressive for you in keeping expenses in there, because I want you to pay as little as possible in that case. So it depends on your objective, and also it depends on knowing your potential buyer and how much you can push in maximizing numbers. So that's what this sheet shows. Okay, so now we're going to apply the multiple. Let's talk about the multiple. So when I say apply the multiple is the number that the value is multiplied by. So the number that the cash flow annually is multiplied by to get the business value. So let's talk about the range of multiple and where that comes from. Historically, for companies, so let's first talk about companies with, let's say, 4 or less sites, 1 to 4 sites. We've historically been a 3 to 5 multiple industry. So what that means is that if we're going to multiply the annual cash flow, let's pick 4, the number in the middle, by 4, then what that says, if you're a buyer, you're going to pay that seller for the first 4 years of cash flow. So some people say to me sometimes, why would I do that? Well, there are different reasons you would do it. First of all, you would do it if you are an inexperienced provider and you want to have a ready-made cash flow stream with a staff in place, and you feel good about continuing that, and you have the funds to do it, and you want to step right in and be making money right away. If you're a person or a company who has had success in starting from scratch, so you opened an empty building or you built a building and you can break even cumulatively in less than 4 years, maybe you shouldn't do it, but that's a risk. So if you're making money, that unless you do something wrong, you can continue making that money. If you open a new building There's always a little risk, even if you're experienced, because I've opened a lot of new buildings and I've broken even in 3 months and I've broken even in 3 years. And if I had that magic answer, I would be rich today. But so there's a risk associated with that. So why would you pay for it? There are a lot of reasons people would do that. So let's pick a 4 number. If we decide that 4 is the right number, we multiply 4 by the 177 that we decided was our go forward cash flow. So the cash flow I'm going to make after I acquire this business. So let's talk about things that affect the multiple. Who decides? You know, do you just haggle over it, or are there some things that affect it? There are some things that affect it pretty consistently. So let me list some of those for you right now. First of all, where you are geographically makes a difference. Are you in what's considered an A market, like Washington, D.C., Chicago, Denver, Phoenix, Atlanta, a large metropolitan market? And the things that go along with that are higher tuition rates, higher demographics. Or are you in a B market, which might be a subset of one of those, or a medium-sized town? Are you in a more rural market where tuition rates are lower? So obviously the higher demographic, higher income markets command a higher multiple, and we adjust from there. So that's one thing that affects it. The next thing that affects it is the age and condition of your facility. If you are in a newer building, less than 10 years old, it's very nice, it's well constructed, it's well maintained, then that commands a higher multiple for the business that's in it than if you're in a 50-year-old building that's in, you know, a little awkward in the way that it's laid out, it needs some maintenance, it could have grandfathered issues with licensing, then that drives the multiple down. The next thing is, how full are you? You know, is your occupancy strong? So the sweet spot for buyers is in the 70 to 75%, maybe 70 to 80% occupancy range. You want it to be in the range where it's making money, but also on the other side of that, buyers are often hesitant to pay full value for something that's 100% full, because what direction you have to go in that case. So down is it. So the sweet spot is, I'm going to buy this and it's making a strong value, but it's got some upside. I think I can kick it up a little higher, make it more valuable, so I don't have to pay for that value because I'm going to create it when I get in there. And that's more valuable than it's 100% full and maybe a competitor comes in and I drop a little bit. Same thing if the occupancy is low, and why is that, and what am I going to do? Am I going to be successful? So sweet spots, 70 to 80%. And the last thing is your level of subsidy tuition affects it. Most of the world feels less secure about subsidy, and when I say subsidy, that includes any outside source of payment other than parent pay for your tuition. And a lot of those are very stable and secure. The investment community worries about those, especially if you're majority funded that way. And the reason is just if there's an economic situation and your state or the feds run out of money and your tuition's gone, then, you know, that's money mainly coming from a single source makes people nervous. So those are the major factors in what drive the multiple. When I say 3 to 5, is it 3 or is it 5? Or because it makes a big difference in that range what that number is. So those are some of the factors that affect it. So if we're going to use 4 as our baseline, it's been a long time since we've done anything under a 4. Like we mentioned, multiples are increasing and we're being very pushy. The market hasn't quite, it's increasing so quickly that we're being more pushy than we would typically be, just so we can test the market. The last thing you want to do is value. You really wonder if you set the value correctly. So we much rather negotiate a little, and most people are prepared to negotiate between 5 and 10%. It's just sort of a rule of thumb in both real estate and businesses, so we're a little pushy on that. So let's look at the actual numbers here. So this just comes right off of the first spreadsheet that we had. We agreed that our annual go-forward cash flow was $177,181. If we agreed, and if you see in the red, that we're going to apply a 4 multiple to that, we just multiply that number by 4. It's just that simple. Why it's called the multiple, we multiply that number by the annual cash flow. So what that says logically is I'm going to buy this company, and the first 4 years I predict it's going to make me $708,723 in cash flow, and I'm going to pay you for that. I'm going to get your business assets to generate it. That's what it's worth. And after the 4-year investment, I'll recoup my money. The next step you see, this deals with real estate and cap rates and all these kind of crazy things you'll hear from Mike and Reagan. And so that is the basis of business value. I would like to take the next, we have 15 minutes or so, and let you guys ask some questions. Again, if you look at your panel box over to the right, there is a section that says questions, and just type those right in there. And I'm happy to take them. Comments are fine. If you want me to go back over something again, that's fine. So I'm getting a question flash here. If I'm missing you, let me know, Reagan. I probably just did such a fabulous job explaining that no one has questions, or you've all gone to sleep. So I have someone's hand up here. So, okay, here we go. How can you separate meaningful owner perks add-backs versus owner expenses that would remain with the new owner? Okay, interesting question. Okay, so let's talk about that in a couple of ways. So the question is how you calculate what you're doing versus what a new person's doing. So let's assume that you're the seller, first of all. What I would do as a seller initially is be very aggressive and just take them out. So let's just assume that those will be eliminated. Let's assume, you know, for the purpose of this discussion, that you have a director in place, you know, you provide some general oversight, but a new owner could come in and basically operate that way. So the day-to-day management is taken care of. Completely different situation if you're the day-to-day manager. Then you have to take your expenses out and assume that a market rate director needs to be hired, and I would use whatever I think that market rate is, because an owner can pay themselves anything they want. It's perfectly legal and logical. You could pay yourself 0, or you could pay yourself every penny the company makes. Don't pay yourself more than the company makes, because then you're in trouble. But pay yourself anything that you want. It's perfectly fine. But whatever that number is, if you can go away and you don't have to be replaced, I know that's hard to imagine, but maybe you don't have to be replaced, remove everything that relates to you personally. If you have to be replaced with someone else, then I would assume a market rate director. So don't assume that person's going to pay themselves nothing or everything or the same thing you are. I would build into it the value to hire a director in that situation. If you're selling to a multi-site organization, I'd take it out. They can argue some of it back in, but again, I always on the sales side assume the most aggressive removal of owner expenses. If you're buying, it's easy. It's easy because you see what they're doing and you know what you're going to spend, so you just remove theirs and put yours in and be generous. So that hopefully that got that question answered. Other questions? Yeah? Oh, okay. All right. Let me grab Reagan's computer because I'm not proficient enough to pull them up. Okay, there they are. I knew I could see them. Okay, how did you get real estate value? Okay, so let me skip that for the second because, again, real estate value is part 2 of this 2-part series, and that, if you missed it in the beginning, is going to be held on November 19th and presented by Mike Pepper and Reagan Curley. So I'm going to skip that for a sec. How would you differ in an independent versus a franchise location? Good question. We work with a lot of franchises, and a very good model as well. Actually, the only differentiation for me is the fees that you pay to your franchise organization. I think otherwise you should be able to operate as efficiently and financially sound as an independent operator. There you need to add in your franchise fees, which are typically 5 or 6% of your revenue. Often there's another 1% marketing fee. And the theory there is that you're getting some value for that, so you may have less in marketing and advertising costs, but be honest with you, those franchises that we work with and sell and value typically spend the same amount of money for those categories, so we don't usually see a difference there. So I would just suggest that the franchise costs are additional costs, and that's typically what we see as a difference. Why would you not add back the reconciliation items before applying the multiple? Okay, so good question, and this is sort of a confusion in the way that we present our numbers. They're effectively added back because they're removed from the numbers. So the way we presented this is that we took them out of the financial statement. So they were in there originally. We are not going to consider those expenses, so we removed them. So our page 4 of the financial analysis was a list of those that were formerly in the expenses that have now been taken out. So we call them add backs. I try to stay away from that term a little bit because it's confusing, but you'll hear it, so I'll talk about it now, and I appreciate that question. So when someone says to you add backs, what that means is they're really taking them out as expenses. Add back means you're adding them back to the bottom line. And it's the same thing as taking them out, but you will hear the term add back, so hopefully I didn't just make that much more confusing. Let me know, Ken, if I did that right. What is an acceptable % of subsidy for an average buyer? Okay, great question. So most every buyer in the world, even those who don't like and don't focus on subsidy, can tolerate 10% or less of your revenue to come from subsidy sources. So if all the other elements are in place, almost everybody's okay with 10% or less. If we get up to the food program range, which is 25 to 30%, there are a couple that drop out. There are about 3 national buyers that drop out at that range, but the majority of buyers are still in the game. They're still okay with an acquisition that is up to that level. They like the food program, the revenue is significant, and they're okay with that transition. When you get above that, there are very few, honestly, and there used to be a couple. Even those are reevaluating their mix today based on what they're hearing in the marketplace that's struggling with the volatility of that type of revenue. So it gets tough. After that, it would typically be an individual buyer that is already working with some of those subsidies or comfortable with it. So really good question. On the income statement, are the numbers in red the adjusted numbers, so the original financials are not shown? So yeah, the numbers in red are those that could change, or typically if anything's going to change, those would be the ones, so that's why I highlighted them. This was just an example financial, so it could have been that and changed, or that, you know, that could have been the change number, so you can look at that any way you want, but those are the numbers that, if anything's going to change, typically changes. What if you lease? How do you determine business value? Okay, so the same thing. If you lease your property, then you're going to assume most of the time that the new owner would pay the same amount in rent to the landlord. Sometimes you can negotiate better terms, and so that's good. That increases your business value. If they're going to pay less rent, obviously the bottom line is going to be bigger, and you'll get a higher number. But most people would assume that the situation would remain exactly the same. The lease would transition over to the new buyer, and you would not change any of those expenses that you've had historically. So still the same, exactly the same if you lease your building. Do you value a struggling center any differently? For instance, or if enrollment is decreasing and most recent cash flow is substantially lower than in the past, would you recommend a different structure to purchase such an operation? Okay, so if you're a buyer and you're evaluating a company and they're struggling and on a downward trend, yeah, that's a tough one. So to base a number on a cash flow value, you want to feel like that it's either stable or improving. If it's declining, I want you to be very, very conservative. First of all, I'd ask a lot of questions about your comfort level with what you could do with that business. Can you stop the bleeding and the decline? Can you improve? And how confident are you that you can do that? And then I would really suggest a low multiple. If a multiple at all, if there is a cash flow, I would suggest no more than 3, and maybe even less if you're the buyer. And if there's no cash flow, then just some nominal value for equipment like we discussed earlier. Good question, thanks. What was the pre-recession multiple range? So we never saw a single center at a 4 pre-recession. Today, we're not doing anything less than a 4 to low 4s, even for single centers, unless they're in trouble. So that's for a single center. Small groups, I think would probably have gone in the 4 to 5, and we're talking 6, 5.5 to 6.5 now. The national groups that would have typically traded at 8 are in the 10s and 12s now. So there's been a big uptick. Let's say 1 multiple point for smaller companies and 2 or 3 for the larger national groups. Shouldn't deleted owner expenses be added back to the cash flow total to make the business worth more? Yes, and so that's exactly right. And so that's what we accomplished in that 4th slide. All of those expenses that were owner expenses were below the line. So if you think about those 4 in succession, the first 3 presented the value. The 4th one was all the initial expenses that were not included in the expenses. So I probably didn't explain that well. So exactly right. Those should be below the line or removed to make it more valuable. When choosing a multiple, when do you include your expenses such as your cost of money, interest? In a multiple of 4, you will take many more years than 4 to get your money back. So interest is completely ignored in business value. It's one of the factors out in the EBITDA analysis. So if you recall, the cash flow number that we're basing the business value on is EBITDA, earnings before interest, taxes, depreciation, and amortization. So interest is ignored. Cost of money is completely different for everyone. So that's ignored in business value, as are taxes, which is complete. And we're not talking about employment taxes here. We're talking about income taxes. So income taxes are completely different for everyone. And then depreciation and amortization are non-cash items. So it isn't. Interest is completely ignored. For a franchise sale, have you ever found a buyer only to find that the franchisor would not approve the buyer? Yes. So we haven't, because the franchises that we have worked in the past, we do work with a couple of the national franchises, and when they let people out of their system and they allow them to deflag and be sold to an individual or a larger company, we work with them to do that. Our model is not to put franchise location. However, we do work with some broker partners who do that as part of their business design. And I have heard them talk about bringing an individual franchise buyer to the table, but the franchise company has a first right to take that school. So I think that happens at times. And I think that's just knowing what you're able to do and not able to do within your system. And if you were considering that, I would certainly talk with your franchise organization read your agreement, be sure you know what their rights are and what might practically happen. But I have not bumped up against that, but have heard of that in the marketplace. Any geographic regions that might be hotter than others right now, more demand? Absolutely. So the major national markets are hotter and more demand, and the ones that we hear on a regular basis, most any major market in the Northeast is hot. When you get to the Southeast, the Raleigh-Durham market has been very strong forever. They were even strong in the recessionary years. Atlanta is back on the upswing. Atlanta struggled with some over-competition and some economic issues, and in the last 2 years has become of great interest again, and lots of reinvestment there. Texas and some of the surrounding states, so Texas has always been very strong, especially the 4 major markets, Houston, Dallas, San Antonio, and Austin. They never slowed down. We're starting to see some interest in Oklahoma and some of the surrounding states there. Chicago is always on everyone's hot list. I jumped over Washington, D.C. D.C. is always on everybody's big list. When I go out west, then I have to hit Denver and Phoenix. Anything on the coast, anything in California is always of great interest. And then you could safely say that any a major market is always on everybody's list. While I'm on that roll, multiple sites are always more valuable, at least if you're talking about the national groups, because multiple site transaction is almost just as much, a single site transaction is almost just as much work as a multiple site. So when someone can acquire multiple sites, then it's very cost effective, and that's always in everybody's sweet spot. So the multiple is applied to the original income statement's annual cash. Well, you take the original income statement and adjust it for any changes that would happen. So it's actually the future cash flow it's applied to. So you adjust anything from the current situation that will change to the situation after it's acquired, and then multiply it by that number. So what you want to know is what the go-forward cash flow is, not today's cash flow. Do you have any thoughts about selling as S Corp versus a C Corp? There are some, that's a really good question, and I'm going to send you back to your tax advisor. There's definitely some things to know and consider and possibly make changes on years before you want an event. And I'm going to leave that one to your tax advisor. I'm an accountant by trade, but been out of the that world for 30 years, so I'll stay out of legal issues and accounting issues, but I can direct you to the right person if you want more information about that. Last one? Last one, okay. With 2 minutes to spare, so I'd like to thank everyone for spending your lunch hour with us. Please don't hesitate to reach out if anything was unclear. You want to consider it again, have us go over it. If you have a situation that you want to talk about individually, if you're looking at buying something or you're years away, so we love to talk to people years away from considering doing something with their company so that we can help you become as healthy as possible and that you go out in the strongest manner possible. So please consider us a resource, and we hope to see you in November on the 19th for part 2, where we'll talk about real estate valuation. Have a good day.